The master of suspense himself probably couldn't increase the tension that many Americans are feeling these days. That tension and nervousness has also been showing in a highly volatile stock market, with corporate earnings coming in and a contentious election just around the corner. The question becomes, are things about to calm down or get even scarier? It's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies and new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. So Halloween may be over, but for many, the suspense and fear over where the financial markets and the country overall might be headed are still very much alive. October is typically a rocky month for the markets, or at least it often is, but this October was rockier than usual as a host of major issues and uncertainties weighed heavily on Wall Street. We'll examine some of those issues on today's show, and we'll focus mainly on how two factors could impact the markets and the economy in the near future: corporate earnings and midterm elections, now just a couple days away. Joining us will be John Najarian, as well as financial advisor David McAdams. But first, let's look at where the market stood at the end of a volatile October and what November might hold in store. If you had to pick a theme song for Wall Street over the summer months, this one might have worked.
And when you worry, you make it double. Don't worry, be happy.
In fact, big investors seem to find a happy place this summer and get over the worries that dogged them during the winter and during the spring, all the way from Groundhog Day through late June. At that time, you'll recall that the markets were characterized by a series of steep drops followed by cautious and partial rebounds. The Dow Jones Industrial Average ended June down nearly 2,500 points from its peak high, which was in late January. Then came summer. An upbeat vibe seemed to take over, and the downward trend basically reversed itself. Now, we had an ongoing series of big gains and small drops lasting long enough that all of the major indices were able to slightly surpass their peak highs for the year and hit new records. The happy vibe continued through September, and then autumn arrived with somewhat of a vengeance. Over two dramatic days on October 10th and 11th, the Dow shed over 1,300 points, while both the S&P 500 and NASDAQ suffered similar losses. The markets have remained highly volatile ever since, with the Dow recently falling back below 25,000 for the first time since mid-July, and thus entering a correction territory along with the NASDAQ. So, what exactly changed between spring and summer and then between summer and fall to cause these big emotional mood swings on Wall Street? The answer is, well, not much. The major issues that kicked off the volatility in the downward trend last spring are the same ones causing most of the current turbulence. In the delicate balance between economic performance and investor confidence, fears have ebbed and flowed over the potential impacts of inflation, rising interest rates, and especially the president's controversial trade policies. We recently devoted an entire show to the trade war issue, focusing mainly on how it's playing out between the U.S. and China as both countries continue to swap retaliatory tariffs. Certain sectors of the economy are being hit hard in both countries, and neither side has really shown any willingness to compromise. No one knows yet how the issue will play out for certain. The only certainty is that the trade dispute seems to be adding another major element of uncertainty to our already unprecedented age of economic uncertainty. Now the question becomes, was the trade dispute temporarily resolved over the summer? Is that why Wall Street seemed able to stop worrying and be happy all summer? Did the Federal Reserve take a vacation? Did the bond market go into hibernation? Did all the geopolitical turmoil that also worried investors back in the spring suddenly calm down from July to October? Well, no. That's not at all what happened. In fact, all those issues, for the most part, intensified during the summer months. The Fed raised short-term interest rates twice in June, again in September, despite criticism from the president. Meanwhile, inflation temporarily inched up closer to 3% in July, as analysts predicted the growing trade war, which also intensified, could eventually spike inflation even higher. Long-term interest rates also rose their highest point since May over the summer, and geopolitical disputes with Korea, Russia, and several other countries continued. So then, why was Wall Street able to mostly ignore these fears and uncertainties for 3 months this summer and embrace this happy, positive vibe, only to get right back to fear and worry once fall arrived? Well, I think the answer to both questions has a lot to do with earnings, as does the answer to an equally important question. Will it be possible for Wall Street to get happy again? Or is the fear and worry only going to get worse? We're going to talk about that a lot more in just a bit. But now it's time to welcome John Najarian. We're always happy when John can join us to share his valuable financial insights here on The Income Generation. And he started his career as an options trader at the CBOE in 1981, following a stint as a professional football player with the Chicago Bears. He now runs his own investing education website, Investitute.com, and is the author of the book, How I Trade Options. He's also regular on CNBC's Fast Money and is always in high demand as a speaker and a market analyst. John, welcome back to the show.
Great to be back with you, David. Thank you, sir.
All right, so let's talk football. No, I'm just kidding. I'd actually like to talk football, but this is a financial show, so we can't talk football. Maybe a little. So how about this crazy stock market in October? What do you make of this?
Well, I think it was a little bit of a taper tantrum sort of thing, David. We saw the same thing in February. The market was at the highs. We got back to those highs just in September. It took that long, 152 days after that sharp sell-off in February. And that's the same thing we experienced in October. I think there are some big differences, but that's one of the big similarities is that people just weren't ready for higher interest rates. No matter how much the Fed talked about it, they just weren't ready for it.
So what are some of those big differences that you're referring to between now and earlier this year?
Okay, one major one is that the European markets, like for instance Germany, their 10-year bond was up around almost 0.9%, the highest it had been since the financial crisis. This time around, David, it's right around a third of 1%. In other words, 0.3 versus 0.9. That's a big difference. And the reason for it, of course, is the just minimal job growth, minimal GDP that we've seen out of the biggest economy in Europe, which is Germany. Mm-hmm. And the same goes virtually across the board in Europe. So when you've got interest rates at a much lower level in Europe, I don't think ours can run a lot higher. When they were at 0.9, yeah, we could pop a little more. This time around, they're taking their rates back down to zero and towards negative again. I think that's going to anchor our rates and not let them go a lot higher than where we got to when we hit 3.25 on the 10-year.
So if everyone's tightening at the same time, not so much of an issue, but if you have some easing going on over there and we're tightening here, it becomes a problem. Good thing, bare minimum, at least the Italian 10-year bond now has a higher rate than ours. That's good news. At least that's starting to price itself a little bit more appropriately. How about the GDP, though? The GDP would make an opposite argument. You know, when we talk, going back to February, the GDP was sub 2%. Now we've seen 4, we've seen 3.5. So do you think maybe that growth can offset the factor that you just mentioned?
Yeah, I think it does. I think the fact that our economy is still growing, that companies based in America are making more money for the shareholders because of the tax cuts and so forth, I think those are both positives. And they're much more competitive against Europe. And that's why you see European growth literally flat, if not down, across the board. I mean, Germany's down even, and as I say, that's the biggest economy in Europe. You look around at Spain and Italy, like you cited, David, the interest rates are higher in Italy, and that's because of risk.
Right.
But I think what's going on here is that there's just not a lot of appetite for those European stocks, and a lot of appetite comes back very quickly, like it has for the last few days, for American equities.
Sure. So in the 30 seconds or so we have left in this segment, tell us this third quarter earnings report so far, what have you seen? Any surprises with one sector doing better than you thought or another sector doing perhaps more poorly?
I think the biggest thing, David, was the tariffs and the drag that they are on certain segments. Obviously, for the Russell 2000 or the IWM, you know, the small cap stocks, not really an issue. But it has been an issue for Caterpillar, hasn't really affected Boeing, and because of negotiations, it hasn't really affected Apple. I think those are positives that they haven't been as affected. And it's going to be bad for China if these manufacturers start looking elsewhere for where they're going to want their goods.
Yeah, makes sense. So stay with us, John, and you stay with us too. We come back, we're going to ask John Najarian if he thinks the Fed is going to create the next recession. We'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Visit the Retirement Income Store at soundincomestrategies.com today to receive your free digital income kit. The digital income kit includes free reports, whiteboard animations, and an educational DVD, all packed with easy-to-understand information on how actively managed income-based investment strategies can help you achieve your retirement goals. Go to soundincomestrategies.com right now and click on the Income Kit tab to request your digital income kit absolutely free.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. If you're a regular viewer, and I certainly hope you are, you know there are 2 points that I frequently make. One is that the financial markets are driven mainly by emotion. The other point I often make is this. Ever since central banks around the world, including our own Federal Reserve, began recklessly overusing quantitative easing, the markets have responded more strongly, more intensely to artificial factors than to economic realities. For years, the main factor was the Fed's manipulation of long-term interest rates and its policy of holding short-term rates near zero. That fueled Wall Street's optimism while also driving many everyday investors up the risk curve and into the stock market by making other investment options appear to be less valuable, less attractive. As a result, from the low point of the Great Recession to mid-2015, the Dow Jones Industrial Average actually rose by over 11,000 points. In spite of the fact that GDP growth during that period was between 1.5% and 2.5% during all that time. Then, not long after the Fed discontinued quantitative easing, the markets had another artificial factor to fuel, and that's optimism. That, of course, being the surprise election of President Trump. The election of any new president typically prompts a market jump, but the Trump bump, as it was typically called, was especially big. It added over 35% growth to the Dow from election day to early January of this year. The bump demonstrated Wall Street's optimism that the president could deliver on his promise of achieving 4% GDP growth by slashing corporate taxes. And guess what? In the second quarter, we did exceed 4% GDP growth. Corporate earnings were remarkably strong. Unemployment was at a historic low, and consumer confidence was at an 18-year high. With all that, it's a little easier to see how Wall Street was able to temporarily ignore all those fears and worries about trade war, inflation, and interest rates during the summer months. Big investors shifted their focus temporarily to economic fundamentals, which, yes, were strong, and the markets got back on track. Nevertheless, that temporary shift didn't really fix the disconnect that still exists between the market and economic realities. That disparity remains in place, and we're seeing evidence of it again as a new corporate earnings season unfolds. Overall, earnings thus far look very good as of late October. Some 3/4 of the 140 companies that had reported third quarter earnings beat Wall Street's estimates for net profit. And 46 S&P 500 companies that had reported, of those 90% topped earnings forecast and 70% exceeded sales expectations. In addition, the preliminary report from the Bureau of Economic Analysis indicates that GDP growth hit about 3.5% in the third quarter of this year. Now, sure, that's not quite the 4% that the president promised or that we saw in the second quarter, but it still suggests a strong, growing economy. And what's more, the unemployment rate remains historically low, and consumer confidence remains at that 18-year all-time high. And yet, even as these stellar reports rolled in, Wall Street continued to struggle, demonstrating once again its fundamental disconnect between real economic drivers and the market's performance. Just as the stock market soared for all those years thanks to artificial stimuli, while the economy was slow and sluggish, investors really shouldn't be surprised now to see it slumping while the economy is by most indicators actually booming. Of course, the important question now is this: will that slump continue or worsen as the year winds down, or will the markets be able to get back onto its happy, optimistic vibe that they enjoyed all summer? Well, the good news is that forecasters expect a very strong holiday retail season, which suggests that earnings and growth for the fourth quarter should both be very strong. On the other hand, here are two important factors to keep in mind. The first one is that even the most optimistic analysts admit that the current strong growth rate is largely a result of the Trump tax cuts, and as such, they agree the effect could be short-lived and that GDP growth could shrink back down closer to 2% as soon as sometime next year. And the second factor, just as all those other issues that weighed on big investors in the winter and spring didn't magically disappear over the summer, they still haven't disappeared. And yes, Wall Street knows it. And what's more is that there's another big issue that could continue to undercut investor optimism despite a strong economy, that of course being the results of the midterm elections. We'll talk more about that in just a bit. But right now it's time to welcome back John Najarian. Now, John, right before the break, you were talking a little bit about China, and I cut you a little short because you know how those commercial breaks go. But, you know, let's talk about this whole trade war thing. How do you think this is going to play out? Can a trade war be won? And if so, who's got the upper hand? Talk to us about that.
Sure. Well, right now we're winning. We being America. China's losing. And I don't think Xi Jinping and the Chinese can stick with their game plan much longer. And the good news for all of us is I don't think they will have to. They were very unlikely, David, to acquiesce and cave in, if you will, for the President of the United States ahead of the midterms, because that would just take away all their leverage. They're not dumb. But after the midterms, they have no leverage. So I think they're likely to cut a deal. They're already losing business to everywhere from Pakistan in the case of clothing and so forth, to Vietnam and Korea in the case of electronics. So I don't think they can afford to have their people not working. And that's what's happening right now is with these tariffs, they have had to basically idle some of these factories. I think they get back to holding on to the customers they've got, because if they went another 6 months like the last 6 months, I think they'd lose a considerable amount of business.
Now, it's funny you say that we're winning. You know, people would look at the GDP growth and say, well, their growth last quarter was higher than ours. They're winning. But then again, if you look at the change of their growth rate's going slightly backward and ours is moving forward. Or are you pointing to our stock market compared to theirs? Because our stock market would definitely agree with you that we're winning.
Both. I would point to both. In other words, as you said, David, our GDP is going like this from the lower left to the upper right. And meanwhile, the Chinese GDP, if you can believe it, because of course these aren't very verifiable numbers that they produce, is either flat or rolling over. And I think also the fact that their stock market is down 20% year to date, that's another thing that augurs against them, because obviously you don't stay in office very long, even if you think you're the premier for life, if you don't keep these factories running, don't keep these new workers that have moved into the cities working and thus eating better than they ate before when they were peasants living out in the rural areas.
Good point. Good point. So I teased up right before the break this comment about the Federal Reserve, switching gears here for a minute, and you know, is the Fed's now locked into raising interest rates? I'm concerned that they might actually create the next recession, as has happened in the past. Do you share those concerns at all?
I share those concerns, and beginning of this month, I think it was October 3rd or so, Chairman Powell, who's a very smart man, made, I think, a dumb comment when he talked about that we're pretty far from the neutral rate, meaning that he thought we were below the rate that we were going to get to over the next 6 to 9 months. Like I say, that spooked the markets, because the markets had anticipated that we were going to see some rate hikes, but they thought we were already close to what the Fed thought was a neutral rate. And now with that statement, that's when the real aggressive selling began in the market, David. So I think what we're going to be looking at is him walking back those comments. And I think either going into the December meeting and or after that meeting, they'll be talking more about, we think we're about there now.
Right.
And I think that will be greeted with a rally rather than a recession.
In fact, John, I bet Chairman Powell wishes he could take those words back as we speak. But we got to take another break. Stay with us. We'll be right back on The Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
We try not to delve too much into politics on this show, primarily because we know that this very loyal Newsmax audience can be just a little bit sensitive about political issues. But also we do it for a number of other obvious reasons. One being that our country has rarely been as divided as it is right now politically. But you know, avoiding politics completely just isn't possible when you're discussing the economy and the financial markets, because economic policies can differ greatly depending upon the political party in power. And let's face it, markets can sometimes respond dramatically to shifts in that power. Which brings us, of course, to Tuesday's midterm elections, perhaps one of the most closely watched and nervously anticipated midterms in U.S. history. Since no one has a crystal ball, it's impossible to say exactly how the elections will turn out or how and if the markets will react to the results. The most common prediction right now, based upon polls, is that it's possible the Democrats could reclaim control of the House while Republicans maintain control of the Senate. As to what that could mean for the president's fiscal and foreign policies is anyone's guess. But as everyone knows, the Democrats have been highly critical of the president's moves and attempted moves on trade, healthcare, immigration, environmental regulations, and if you think about it, really just about everything else that he tried to do. And the massive tax cuts now fueling growth and earnings, whether temporary or long-term, were passed without support from a single Democratic lawmaker. Already, the anticipation of a divided government is impacting investment choices and forecasts, and this according to a recent Goldman Sachs analysis. For example, investors have been positioning for the outcome of buying pharmaceutical stocks based on a belief that that sector is unlikely to undergo any serious regulatory changes, even if control of the two chambers is split after the election. Pharma is up almost 10% year to date. Other sectors expected to be largely insulated from a political power shift for various reasons include aerospace, technology stocks, and this all again according to a Goldman Sachs survey. But for the market overall, many investors have expressed concern that a power split could mean an intensification of the Russia investigation and other controversies surrounding the Trump administration, as well as an increase in uncertainty surrounding fiscal deadlines. The issue of fiscal deadlines could lead to worries of more government shutdowns, like those pressured the stock market in both 2011 and 2013. Now, one positive point for investors is that historically, midterm elections tend to have really little impact on the markets. Yes, the stock market is typically volatile in the weeks leading up to the election, and this market has certainly been true to form in that respect, as we just discussed. But in the aftermath of the vote, regardless of the outcome, the volatility usually decreases. Why? Because the uncertainty is no longer such a major issue. Now, as regular viewers know, I'm a big believer in the idea that history tends to repeat itself more often than not. And it may just repeat itself this year. It may be that regardless of how the elections turn out, we'll see the markets able to return to a strict focus on growth and earnings, and to the kind of happy, optimistic vibe that gave Wall Street a strong overall summer. On the other hand, even if that happens, the important thing for everyday investors to keep in mind, as we've said, is this. With uncertainty over the election no longer a factor, and with the economy doing well, it still doesn't mean those other fears that have dogged Wall Street all year have gone away. The trade war, the Fed's pace on interest rate increases, inflation fears, those are and they will remain major elements of uncertainty that could possibly undermine the effects of the president's tax cuts, as well as the growth that we've seen so far this year. You can also add to those issues increasing worries about the still rising federal deficit, a troublesome slowdown in the housing market, slowing growth in Europe and China, falling oil prices around the world, a potential global dollar shortage, and yes, the list goes on and on. The point is this. Regardless of how the election turns out or how the markets react, we're still living in this age of unprecedented economic uncertainty, and an age in which I believe overprotection should absolutely be the number one priority for Americans over the age of 50 where their money's concerned. I'll talk more about that in just a bit, but now it's time to bring back one last time John Najarian. So I guess what we're talking about is really that we have a couple issues. We have the Fed saying they want to be more aggressive in raising rates. We have the long end of the yield curve being artificially held down by, as you said, Germany and other foreign European countries whose long-term rates are down. So now it goes back to that argument that I've been bantering back and forth. You and I have talked about it before, for maybe going back a year or two, about the possibility of a flat yield curve and what that could do for the economy. That's got to be factored in too, correct?
Yeah, it does. And you also talked about the possibility that the Fed could drive us into a recession. It's something that you and I worry about. It's something the President of the United States worries about. And he's basically come out not calling Powell out, but saying he doesn't think that they're doing the right thing, accelerating rates as they have throughout this hike cycle. I think that's about to stop, though. And if indeed it does, then I don't think you're going to be looking at a flat yield curve. I certainly don't think you're going to invert the curve if that happens. As you say, though, if they just stuck to the path of a December rate hike and 3 more in 2019, yes, they could drive us into a recession. And obviously the Fed doesn't want to do that.
So when you're doing your mental mathematics in this whole thing, how do you know, it's kind of like you take all these facts, you put them in a blender, you push the button, and you see what comes out. So when you put the ingredient in the blender of this mushrooming federal deficit, what do you make of that? You know, are you in the camp that, hey, if we stay at 3.5 or 4% GDP, we can grow our way out of it? Or do you think that still that type of deficit is going to create a real issue?
I think the deficit creates a bigger issue, to your point about the Fed, if the Fed keeps hiking rates, because obviously we're paying back at a higher rate. So that's a real issue with the deficit. Deficits are easier to stomach when the rates are closer to zero. When they're moving up and we've got a 10-year rate that's at 3.10, let's say right now, obviously that's a bigger problem than when it was 2% a year ago. So I think the president and the Congress need to pay more attention to deficits here, because I don't see us heading back to 2. But on the other hand, I think cutting back on the deficit, we've had record inflows of tax receipts, highest on record, and yet we're still outspending what we're taking in. So obviously we know which side of the equation is the problem, and we've got to address that.
Now, John, final question is, we talk a lot about fixed income and generating income, and, we don't have a lot of stock market gurus like yourself on the show, but you're one of the ones that seem the reasonable middle of the road. I think you've said in the past that, hey, once people's income needs are met, then fine. The stock market's a great place to be with extra money. So with our income generation viewers' extra dollars, what do you see in the stock market? What's your crystal ball see for 2019 and 2020 moving forward in the last 45 seconds or so in this segment?
Sure. I think that overall we've got a market that could still push a lot higher. And I do think that stocks in particular that could be playing catch up are stocks like Caterpillar. It's a great global company. And if you see lessening of the rhetoric between the U.S. and China, if you see President Trump at the G20 talking to Xi Jinping, shaking hands and all that, I think those are going to be positive signs, obviously for Boeing, but it's not far from its 52-week high. Caterpillar, on the other hand, really needs that kind of help. And I think stocks like Caterpillar and Honeywell would do extremely well if we can come to some sort of agreement on tariffs.
So it sounds
That's what I'd say for 2019.
So your optimism is about getting an agreement on tariffs, which you think will happen, and maybe long-term rates in Europe, keeping our rates down to keep the economy moving. So John, my pleasure. Thank you so much for being on the show once again. You stay with us. We'll be right back with more here on The Income Generation. We'll be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
In my book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad, the number one value I identify is overprotection. In other words, if you're retired or within 10 years of retirement, protecting your assets should be one of your top financial priorities. If you're a regular viewer, you already know the strategy that I recommend for achieving that goal, and that's switching your focus from portfolio growth to retirement income, and to work with a qualified advisor who can help you implement strategies designed to do 3 things. First, to protect your principal from market volatility and spend down, to generate reliable income through interest and dividends at competitive rates of return, and to grow your portfolio organically through strategic reinvestment of those interest and dividends. It all starts by making that strategic shift from focusing on growth to focusing on income. Now, while there's never a bad time to make the shift once you're over the age of 50, there, yes, can be better times than others, and I would argue that right now might very well be an ideal time. As we've discussed on today's show, The stock market has had worse Octobers than this one. But with all three major market indices falling into or close to correction territory for the second time this year, despite strong quarterly earnings and growth, everyday investors would be wise to take heed. Yes, there is the chance that the market could get back on an upward trajectory as it did this summer. But if that possibility is what's making you reluctant to shift your focus from growth to income right now, then you're overlooking what I believe is an extremely important detail. The stock market is, and for a long time has been, significantly overvalued, which is another outcome of reckless overuse of artificial stimuli. Even if it manages to get back to an upward trend, the odds are that it'll maybe be able to climb another 5 or 10 percentage points above its recent peak, probably at best. In order for it to continue to climb higher, economic growth would have to continue at its current pace and for many quarters to come, so that real earnings could finally catch up to what seem to be overinflated stock prices today. As we've also discussed on today's show, many analysts doubt that that's possible in light of so many global, economic, and geopolitical uncertainties, and given the limited potential impact of the president's tax cuts. Either way, keep in mind that the markets do eventually have to make fundamental sense again. If that doesn't happen by earnings catching up to overinflated market prices, then it typically happens by the market dropping to align with corporate earnings. History suggests the next sustained market correction really should be at least 40%. It could be as steep as 70%. And that, I believe, is what makes now an ideal time to embrace the value of overprotection. How? By switching your strategic focus from growth to income. By not doing so, you're only gambling for potentially an additional 5 or 10% gain. But by doing so, you're protecting yourself from potentially a 40 to 70% loss. Question becomes, which makes more sense to you? Now, let's see which makes more sense to our next guest, David McAdams. David is president of McAdams Group, LLC, based in Memphis, Tennessee. He's known nationwide as a highly sought-after speaker and financial educator, and he shares his insights and advice frequently on magazines such as Forbes, on the radio, and in other financial media outlets. David, welcome back to the show.
Hey, thanks for having me back.
So, we've known each other for a long time now, and although we haven't talked recently about what's going on in the markets, and you just heard John Nigerian, who said that there's some positives, some negatives that worry him, but overall he thinks with the economy going that the positives should outweigh the negatives for at least the next year or two in the markets, extending this bull market rally even further. What's your take?
He probably has a good point in the near term. I mean, frankly, with where we are with interest rates, the concern, of course, is if the Fed pushes interest rates higher in the near term, that we could see a flattening of the yield curve. If they push interest rates up too fast, too soon, then it's likely that banks would decrease their lending, which could force a recession. So that's where there's a lot of uncertainty there, because if that happens, I would tend to be in the more bearish category. What he's talking about is the next year or two. Of course, we've got kind of a strong tailwind with some of the economic policy change with the new administration in force. And the question is, how much longer can that go before the levee breaks? I kind of agree with you with your commentary in your monologue that we have seen such bull market rises in such a short, fast period of time that I really wonder if that would have happened without the stimulus package that the previous administration put into force, and really without what's famously called the Trump bump and the tax law effect and the economic policy from the new administration. I doubt you'd see market prices where they are today. So are we at a tipping point? I think you really have to keep an eye on those interest rates, because that could signal the next recession if they go too fast, too soon.
So the Fed's in the driver's seat to some extent, and people on Wall Street always say you can't fight the Fed. I know you've heard that a bunch of times. Dave, Sure. Stay with us. We're going to be back. You stay with us too. We'll be right back here on The Income Generation. Welcome back to The Income Generation. You're here with David Scranton and my good friend David McAdams from Memphis, Tennessee. So David, it sounds like you're saying there's a little bit of a carryover from all the quantitative easing that's helped us, maybe even some of the quantitative easing in Europe that John and I had spoken about. Also the optimism from the Trump bump. But you have a strong background in tax. You're a CPA by trade. So how much do you think the tax cuts are helping to spur GDP growth, and how long do you think that could last?
That's a great question. And actually, I actually thought before they passed the tax law that some of the earnings in the S&P 500 from 2017 probably already took that into consideration because there was high optimism that the Tax Act was going to pass. And some people argue it was already baked into the valuations. I mean, the valuations are very high today. They're very rich. It doesn't mean that there's not room for upside. I mean, frankly, as you know, back in the 1990s, as a price to earnings ratio, I mean, stocks have actually traded at higher values than they are today.
Sure.
I think the Shiller PE ratio, which is kind of a moving average price to earnings ratio, is somewhere in the 30 to 32 times earnings range. Now, having said that, stocks are getting rich.
And according to Shiller, the only time that ratio has been higher was in 1929, which is also an interesting statistic.
Right. And so, I really think a lot of the valuations were already baked into the Tax Act. You've seen massive volatility this year. We've seen several downturns of greater than 5, 6, 7% already in 2018. We're pretty flat at this point during that period when you consider all the downturns and recoveries.
Sure.
So I really think a lot of that was baked in. I'm not expecting a lot of upside potential just based on the tax savings. But of course, they're working on other economic policies that could impact stocks positively. It just depends on how the political environment plays out.
So in the 30 seconds or so we have left in the segment, tell our income generation members then, what do you think is going to fuel the optimism over the next year and a half to get that short-term bump before things come back to normal again? Do you think maybe that the trade war will turn out favorably, maybe a few more quarters of 3-4% GDP growth before things get back down the twos? What do you think are going to be the biggest drivers?
I do think you're going to have to see continued GDP growth. And as far as the trade wars, President Trump said when he initiated and started down that path that you're probably going to have some short-term pain, but he was going to work hard and negotiate things that would be in favor of our domestic stocks and our economy. And so I think if he continues down that path, we will see positive events. The biggest issue, though, is how long can that keep pushing
How long can
up?
it go, right? Because we're already 9.5 years into a short-term bull market. It's near a record. How long can it go? I agree completely.
As you said,
Dave, so unfortunately, we got to leave it there for today. I apologize. We got to take a commercial break. Stay with us. We'll be right back with more here on The Income Generation. I'd like to take this opportunity to thank both of our guests for joining us for another episode of The Income Generation. More importantly, I'd like to thank you, our new and returning viewers. Over the years, I've used a number of different analogies to explain how focusing on income instead of growth is an ideal way to protect your assets and to meet your retirement goals. The analogy that I've been using recently came to me while engaged in another job that I'm passionate about, and that's teaching people how to fly airplanes. Naturally, that's also a job where the main focus is on safety. And sometimes the safest way to fly an airplane is to do it in a non-intuitive way. In other words, the exact opposite way in which you would normally fly. You see, normally a pilot uses power, the power from the plane's engines, to control speed. He used the pitch of the airplane, its angle up and down, to ascend or descend. He flies this way when the plane achieves an optimal speed where it has what's called a maximum amount of lift created in relationship to its drag. This is known in airplane physics as LD max, lift to drag ratio max. But when traveling below the speed of LD max, the pilot is flying what we call behind the power curve. And in this situation, his best and safest strategy is to fly the plane in a way that's counterintuitive. This time using power to ascend or to descend, and use the pitch of the airplane to change the airplane's speed. In other words, just the opposite. Now, just as there's an optimal speed for a plane, there's an optimal amount of money that each investor needs to meet his or her retirement goals. You might say that any money in excess of that amount is ahead of the power curve, while money below that amount is behind the power curve. When investors aren't aware of this, they often instinctively think that they can put all their savings into the power-based strategies, even if they're behind the power curve, which means, in financial terms, investing for growth. Now, while that may be okay for money that's ahead of the power curve, excess funds, it doesn't really work for the money that's behind the power curve. With that money, I believe you're better off resisting the urge to use power and instead using pitch, which in financial terms means investing for income. That's because if it's behind the power curve, it's money that you simply can't afford to lose it all. And income-based options, as you know, are designed to protect principal while providing the opportunity for organic growth. How? Through strategic reinvestment. As we've discussed on this show, I believe now might just be an ideal time to make that switch from power to pitch. In other words, from growth to protection and income, and going with the momentum instead of against it. Thanks for watching. Here's the bottom line. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton. Thanks again, and we'll see you next week.